Hello, in this presentation we will enter a loan payment adjusting entry to break out the short-term and long-term portion of the loans payable within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be breaking out the short-term and long-term portion of the loans payable. In order to do that, let's first take a look at the short-term and long-term portion by going to the reports on the left side, and we're going to open up the balance sheet. So we'll select the balance sheet, and then we're going to change the date range. We had the month of January and February that we were working on. We're going to be entering these adjusting entries as of the end of the second month of February. That then will be our cutoff date. I'm going to make the range for the full 2 months, which is 01/01/21 to 02/28/21. So it's going to be for the full range here. This will be a point in time, but of course we want to be able to drill down on the numbers and see the full 2 months of activity as we do so. So then we will run that report. So here is the report that we have run. And we're going to scroll down here and see what we have. We're looking for the loans payable account down here. We've got the loans payable. We're in the liabilities section. Remember that the loans payable is different from the accounts payable in that it's typically more of a long-term loan. So accounts payable being due within 30 to 60 days being normal part of operations. Loans payable typically being due for a longer period of time and often having interest charged to it. Now note that although the loan is a long period of time, it may not be a long-term loan. It may still be short-term in terms of the current versus long-term portion, because 60 days or 30 days is really what accounts payable are normal business processes for normal purchases. But the loan could be something for like 3 months or 6 months and still be under the threshold of 1 year in order to be current. It's also possible for us to have different loans, so the loans can be a little bit tricky when we do these adjusting entries. Some companies will have a lot of loans on the books, and our question is, do we want to break out the loans in separate accounts? Do we want to group them together as we have done here, all into one account? This one account has multiple loans in it, and then try to break out the short-term and long-term portion. That, in essence, is what we're going to be doing in this loan process. Or do we want to break those loans out into different loans? It's also possible we have to look at the terms of each and every loan really too, because the loan could be financed in a way that like most finance would be for like a car or something, or a mortgage type loan, where we pay off some of the interest and principal with equal monthly payments. But it's very common for other loans too to have different types of formats. It might be that we're going to take a loan out and not pay interest or principal until the end of the loan, and we have different types of formats of the loan. So we'll go over some of those issues as we take a look at this. Note what we told basically the bookkeeping department. One way we can deal with this is to say bookkeeping department or accounting department, whoever's actually recording the loan when the loan was taken out. It might be easier for you just to have one loan account. You put that loan into this one loan account, and then we're going to go in and adjust it for the short-term and long-term portion, which could differ after every payment. It could differ after every payment and as time passes. So let's take a look at the activity. Here's the 74,878, and we can see that it started. If we look at the detail here, we started with the beginning balance of 22, then we took out another 50, then we made a couple payments here, and then we took out another 5,000 to increase the loan. So the loan we owed 22, then we increased the loan by 50,000. And then we made a payment bringing it down, and then we took out another loan of 5,000. So our first question when looking at detail like this is, well, are these all the same loan? Are they different loans? Did we just adjust the terms of the one loan? Is it some kind of line of credit? We'd have to get the policies to back up this information. We're going to say that this is these two loans are the same. The $72,000 loan is in essence one loan. And this second loan, we're going to say, is another loan. That's the loan we took out on equipment. So we're going to look at the terms for this loan, the second loan first, the shorter one, and figure out what to do with it in terms of short-term and long-term portions. and then we'll go back and adjust this loan, which is a bit more complex, is a bit bigger loan. So first we'll take a look at this loan and just look at the terms of it. And oftentimes what we need to make the loan make sense is an amortization schedule. So we're going to actually put together an amortization schedule. This will be a simplified amortization schedule within Excel here. And then this will lead us into the next amortization schedule we will have for a more complex type of loan. Note when you have a loan, you're typically going to have the loan amount, the interest rate, the number of payments, and then they might give you the amount due, in this case at the end of the loan, or the amount of payment amount due. In this case, we're going to say that the loan, and by doing that, what we don't have typically is an amortization table a lot of times. And we might want to put that together and say, well, what's going to happen over time in terms of the table? So what we're going to do is take this information and make a table out of it and make some look at it in terms of a table. And then we'll use that to make our adjusting journal entry. So here's our loan terms. So we would just take this from the loan document, putting it into our Excel sheet. Here's our loan, 5,000 months, 6 months, rate is 6%. Now we're going to assume this loan's a bit different than a normal like car loan or mortgage loan. It's going to be more like a business loan where we said, hey, we're going to take out 5,000. We'll pay you back in 6 months. We need the money now. I don't want to pay monthly payments. I want to use it until the end of the time period, and then we'll pay you back at the end. And they're going to say, okay, well, you pay us 5,000 back plus the interest of 6% as of the end of the time period, which means that we're going to have to pay back the principal here plus the 6% interest at the end. Now, first off, right away, we can tell that this is all going to be short term because it's only for 6 months and it's not for over a year. So the entire loan is going to be a short term loan. So we know that right off the bat. But there is this idea of the fact that we're going to have to pay more than 5,000 at the end. And so let's calculate what that interest is and discuss whether or not we should put 5,000 into the current portion or what we're actually going to pay within 6 months and how that plays out. So we're going to calculate the future payment. I'm going to use an Excel formula in order to do this, and then we'll do this with a table. So this is you don't have to know this Excel formula, but just some added information if you want to take a look at it. A couple ways we can do that. We want to know what the future payment's going to be. So we've got 5,000 loan, 6 months, and then interest rate is 6%, and we're not going to pay any of it, interest or principal, till the end. So what we want to know is the future value, what it's going to be worth at the end, what we're going to have to pay in essence. We could use a couple different formulas. I'm going to go to the formula tab up here, and you can use this insert functions that could help out. And what we want is a future payment, or future value we should call it. That's going to be the FV value. So I'm going to select that, and it'll give us a nice little input box here. And we could say that we just filled out the box. This is going to be the rate. So I'm going to take that rate. Now the tricky thing is that rate is a yearly rate, and we really want to make it a monthly rate. So I'm going to take that rate and divide it by 12. That's kind of the trickiest thing to dealing with interest for most people, because when we see an interest rate, we just don't really totally understand that the interest rate really means a year. Typically, if no one says anything about an interest rate, they say the mortgage rate is 5%, it means 5% a year. And we only want to break it down to a period interest rate, which is a monthly period. So we have to take that yearly rate and divide it by 12. And then we're going to say the numbers of periods. We're just going to say is 6 here. And then we've got the payments. Now the payments, we're actually going to say there are no payments during those 6 periods. That's a bit tricky with this type of calculation, because this same calculation will be used when we have annuity payments, and that's why we have the 0 there. What we do have is the present value then, and these two aren't always there depending on the type of calculation. That's why they're not bolded. But in this calculation, we need it. So the present value is what it's worth today. This is how much it is today, 5,000. And if we have that information, note that you have this little box down here that'll tell you what each of these say. We're going to say that is it. We're going to say OK. And then it'll give us the amount that we'll have to pay. So we got the $5,000 loan. We got $5,000 today. We're going to have to pay back after 6 months, $5,152. I'm going to make this a positive number by just putting a negative in front of the F. So I'm going to put a negative. That just means take that, multiply times -1, and that'll flip the sign. So here's our number of payments. Now for us, there's a couple issues here. One is, is this short term or long term? It's all short term. And then because it's only 6 months and not over 12 months. And two, what do we do with this interest amount? Do we put the short term? I mean, we're going to actually pay $5,152 in this time period. And so do I put that in short term, or do I put the 5,000? And note we're gonna use probably the 5,000 because we don't yet owe the 152. That's going to be kind of like rent. It's kind of like rent on the money. So even though we're going to pay 5,152, it's not a liability at this point in time because time has not passed. The 6 months hasn't happened yet. So that would be like prepaying our rent. That would be like paying the interest, or saying we owe the interest before we lived in the home. This would be like saying if we put the 152, it would be like saying we owe the 152 before we used the money. Now we're gonna put the same information into an amortization table and get to that same number. One, to recalculate it, just so we can see how that amortization table works. And two, we're going to need this later when we calculate the interest amount. And then three, it'll look better, and this will give us a little idea of how different loans work, and we'll be able to compare and contrast this when we do a more complex loan that's more similar to like a loan payment that we pay monthly. So here we're going to say there's going to be six time periods. And we usually call those payment amounts, but there's no payments. We're not going to make any payments in this particular loan till the end. So the payments are really zero. These are really, payments probably not the best term of it, but we're going to use the same term because we're going to use that term when we look at a loan that has regular monthly payments. And then we're going to say that the interest amount is going to be the amount that we're going to have to owe or increase in interest every time period. So the interest will be calculated as we have the 5,000 up here, 5,000 principal times 6%, 0.06. That would be 300 a year because that interest rate is per year. If I want to break it down to a month, divide by 12. That's the 25. When we did this calculation, note what they in essence did there. They took the 0.06, 6% divided by 12. Got the interest rate, which is really small, which is why we don't really use monthly interest rates, and the typical standard is a yearly interest rate, and then multiply times the 5,000, which is the 25. So we'll do that same thing down here. We're going to say the interest equals this 5,000 times 6% divided by 12. So that's the interest. Now the principal usually is a reduction in principal if we were making payments. And again, I'm formatting this as we will see when we have a loan that has monthly payments. In this case, the principal is going to go up. It's an increase in principal. That means that we had 5,000 and now it's increasing to 525. So after 1 month, we actually owe 5,025 now because this interest has accrued. We're going to have to deal with that, but we're not going to put it into the loan payment. Payable, we're going to make another account and say, hey, we owe interest, in this case of $25, that we have not yet paid. We'll deal with that in a later adjusting entry. So we're going to do the same thing here, and now we're going to say that we have 25, though, the principal goes up, times 6%. So it's divided by divided by 12. So it should be a little bit higher. If we add decimals here, we'll note that it went up just a little bit because we increased the principal. And then if we subtract this out, then this minus this would be that. And our principal now is going to be this is going to increase by another 25. And then if we keep doing this, now note the principal went up a little bit. We're going to multiply that times 6% and then divide by 12 and then divide by 12, and it went up just a little bit again. And then we're going to subtract this out. So it's going to increase the principal like so. Now we can copy and paste this formula down. It should look very similar. If we do it just one time, I'm going to highlight these 3 cells, put my cursor right on that little dot, and scroll down. And it doesn't do exactly what we would want. That doesn't look right. So if I click on it, we're going to say this cell looks right, that cell looks wrong. This cell moved down. I don't want it to move down. So how can we fix that? I'm going to delete this now. We'll put our cursor back on this one, and what we're saying, I'm double clicking on that. This cell right there, I want to keep it the same. So in order to do that, we use what we call absolute references. So that's cell B5. So within B5, we're going to put dollar signs. Dollar sign before the B, dollar sign before the 5. The dollar sign does not mean it's a money value. It's for whatever reason Excel uses the dollar sign as a kind of a code to say don't move that cell down. This basically says do not move the B or the 5 when you copy and paste the cell. So we're going to say OK, and then copy this down. So I'm going to drag it down just one first, and then it looks correct. So that looks like what we want. And so then we're just going to drag it down to the end. And there we have it. There's the 5152, which matches what we got here in the Excel formula. So this gives us a little bit more visual of how we got to that number, rather than just the formula just kind of spitting that number out at us. It gives us a little bit more verification that what Excel did here was correct. So we're going to use this table in a few different things. We're going to, one, use it to record the interest that will be due, the accrued interest that has not yet been paid that we do owe. And we're going to use it in order to adjust the short-term and long-term portion of the loan, which is all short-term in this case, of the 5,000. That's the adjusted entry we will do now. And we'll use this comparison to a more complex loan or a different loan where we do have monthly payments that will have an interest portion and principal portion. So what we're going to do now is we're just going to pull out that 5,000 that were determined was all short-term and put it into a short-term loan in the current section. Here we are back at our QuickBooks. I'm going to go back to the balance sheet. So here we have our loan payable down here. What we really want is another loan payable up here. We want a short-term loan payable up here. So we need another account. It's just going to be loan payable short-term, or we can call it loan payable current portion. And we're going to pull that 5,000 up here. Now once we do that, we're not done yet, because we got that other loan in here that may have a short-term portion as well. So we're going to do this one loan at a time. And we're going to go to do that. We could add the account first. So we could go to My Accounts down here. And then we want to go, we want to go to Accounting down here. And then we got the Chart of Accounts. We want to be on the Chart of Accounts. And then we want to create a new account. So I'm going to create a new account. And the account is going to be a liability type account. So we're going to select the other current liability type of account. And then in the detail type, we're going to select the loan payable type of account. So it's the loan payable. And we're going to say it's a loan payable, and we're going to call it, just to differentiate it, the current portion. Something like that, current portion, if I could spell it right. Maybe we don't need portion. I'm just going to call it current. Now, this is, again, another thing that will just be in terms of your preference, whether you want to put current or not. When you see it on the balance sheet, it'll be under the current section. So we won't really need to say it's current because it'll be in the current section. If you see it on something like a trial balance, however, or when you're making a journal entry, it might be useful to see the current portion because it's not going to be in the context of a financial statement. So it's really up to you as to whether you would want how exactly you want to name it, whether you want to name it current or not, or just let it land where it lands. It will be in the current section as opposed to the other loan payable we have, which is in the long-term section. So we're going to save and close that. And now we're going to make our adjusting entry. Now normally, and we will use some debits and credits, some journal entries here. And so normally you would go up top and you would have the journal entry that you would want to enter. This journal entry in the others section. So we went to the plus item in other journal entry. Typically these adjusting journal entries at the end of the time period would require the use of debits and credits. They're not kind of like normal transactions that the QuickBooks has a form for that you would just do every day, and therefore have a form for that QuickBooks would just set up and basically have an input screen where we would not need to know debits and credits. So if we were to do this, we would have to increase the current portion with a credit, which would be the 5,000 credit, and in the current portion, and then debit or decrease the long term for 5,000. We're going to try to do it here with just the registers, just to see if we can do it that way, and just to show that it's kind of the same thing to do it that way. So this would probably be the easiest way to do it. But we're going to work with the registers as long as there's only two accounts in the adjusting process because it's possible to do that way. So remember that when we look at the registers, we usually think of the checking register. So I'm in the accounts over here. We're in the chart of accounts. We usually work with the check register, but QuickBooks has set up a register for every balance sheet account. So if we're dealing with a balance sheet account, rather than go into the journal entry, we could work with the registers. We have one set up for the loan payable already. So if we go down here to the loan payable, here's the current loan payable, and then we had the long-term loan payable. So if we go to the long-term one, here's loan payable that we had set up before. It has the 74,878 in it. We'll see what's in there now. So I'm going to go to that account. And here's our detail. So this is kind of like our GL, and it has that 74 in it. We need to decrease this one and then put the other side into the short term. So note, we can kind of think of it here without the debits, the credits. We could just say, well, this one needs to go down and the other one needs to go up. Once we get to more than just 2 accounts affected, then these registers become more confusing than journal entries, and I'll just go to the journal entries. But when there's only 2 accounts, it is possible to use these registers. So I'm going to say that we want to add a journal entry. Notice there's no really other option here. We have a transfer and a journal entry because that's typically all you really got on a loan payable, because it's not a normal transaction as opposed to cash where you'd have different types of things. You can write a check, you can enter an expense, and all this other types of options. So we're going to say journal entry, and we're going to date the journal entry as the end of the second month, 02/28/21, as all kind of adjusting entries are. This is basically an adjusting entry. We're not going to have a payee or a memo. We're going to decrease it by 5,000. And we might want a memo saying this is adjusting entry or something like that, at least adjusting entry. And then we would want to be down here, and we're going to say the other side. Where's the other side going to go? To the current portion, the other account we just set up. So we're going to say this one's going to go down and do whatever you need to do to the other side, which is going to be increase the other loan payable. We could select that by selecting the drop down and or typing in loan payable and then the current portion, current liability, as opposed to long-term liability. So we want the current loan payable. Then we'll make sure and save that. And then we're going to go back, and we could check this out one in the register. So if I go back up to the register and we go and look at that other loan that we set up, which was a liability account down here. It's in order: assets, liabilities, equity, income, except here's the current portion. There's that loan payable. And if we select that register, we'll see that it has now appeared here because of the other entry that we just made. We can also look at it on the financials, as we will. So let's go to the financial statements. We want to go to the reports. We want to go to the balance sheet. And we're going to change that date once again from 01/01/21 to 02/28/21 and run that report. We're going to scroll back down, and we see that in the loans payable, we have the 5,000 there. There's our current portion, and here's our long-term portion that went down. If we click on the current portion, if we select that detail, we will go to what? A journal entry, not the register. And because again, what we put into the register was a journal entry. So this is what QuickBooks thinks that this is like the default form for something that has no other form for QuickBooks. QuickBooks doesn't have, there's no check that does this, there's no invoice. So it goes then to the last kind of resort, which is a journal entry. And we can see that we debit the loan payable to decrease it, and we credit the loan payable current portion to increase that amount.